All right, well, thank you, Neil, and good afternoon, everyone. Before I get started, I would like to thank the Hamilton Chamber of Commerce for hosting me here today, especially having heard the story of how that all came together. It's really my pleasure to have the opportunity to give an update on the Canadian economy and to discuss the interest rate decision that we made yesterday to keep our policy interest rate at 1.75%. Now, this decision hinged on a number of factors, and one was the slowing momentum in the global economy. It's increasingly clear that ongoing trade tensions and associated uncertainties are having an impact. And I'm sure for some of you here in Hamilton, you can relate to this as you deal with the steel tariffs. Now, another factor was the performance of the Canadian economy in the fourth quarter of 2018. And while we had been anticipating a slowdown coming primarily from the oil sector, the slowdown was sharper and more broad-based than we had been expecting. And this is despite strong employment and labor income growth and core measures of inflation that have continued to hover near our 2% target. Now, part of this sharper slowdown came from weakness in household spending. And so that's what I'm going to spend the bulk of my time talking about today. But before I do that, I want to just step back and take a look at how the economy's been evolving over the past couple of years. Now, as many of you will recall, 2017 was a very strong year. Growth came in at 3% with notable contributions from exports, investments, and household spending. This growth in household spending was supported by employment gains, which fed into a healthy rise in disposable income of about 4.5%. Now, income tax cuts and the Canada Child Benefit provided a further boost to spending. So in this environment of steady house price appreciation and favorable conditions for borrowing, spending on housing also continued to increase. With growth above potential, the slack in the economy diminished and inflation was approaching 2%. So in mid-2017, we began to move our policy rate. Now, turning to 2018 as a whole, the economy grew by 1.8%. And while this moderation in growth had been anticipated, it was shy of the forecast that we put forward in January in our monetary policy report. Growth in 2018 was also broad-based, with solid contributions from exports and investment and household spending. Household spending grew, though, at a lower, more realistic pace from the unsustainable rate in 2017. Now, as for inflation last year, it rose from about 2% at the beginning to peak at 3% mid-year, reflecting some transitory impact of higher gasoline prices and airfares. By mid-autumn, oil prices began to fall, which contributed to the return of inflation to 2% by the end of the year. So there was a fair amount of volatility through the year, but inflation remained near target, and all three measures of core inflation were around 2%. So this was in line with our view that the economy was operating close to capacity. Now, looking ahead, and consistent with the numbers that we received for January, we're forecasting inflation to be slightly below 2% for most of 2019. Now, this is largely the result of temporary factors, including the decline in oil prices since last October and a wider output gap. Now, given this background, let me now turn to household spending. And this is always an important topic for us because it makes up more than half of our economy. But it's even more so today when we think about how high levels of household debt are affecting spending decisions. So today I'm going to discuss what household spending includes, what influences it, and most importantly for monetary policy, what factors have been contributing to the moderation in spending that we've seen over the past year. So let me start by defining where different types of purchases end up in our forecasts. So Statistics Canada considers the construction of a new house, renovations, and also the costs associated with buying a house as part of a category that they term residential and investment. And for our purposes, we call that housing. Okay, in contrast, consumption is defined as spending on goods and services which are typically consumed by your household in the year that they are purchased. So goods accounts for about 45% of consumption, and it covers everything from cars to clothing, groceries, and gardening tools. And the remaining 55% is services. And they range from haircuts to childcare, restaurant meals, and the biggest being rent and utilities. So rent is defined as that amount you pay, of course, if you're living in an apartment, but if you own your house, it's a portion of the cost of living in it. So it would be the equivalent of what you would pay if you were renting your own house. So Canadians dialed back their spending in 2018, and consumption growth moderated by about 1.5 percentage points from the year before, and housing by about 5%. So this resulted in an overall contribution of household spending to annual GDP that was about 1.25% lower than it had been in 2017, and a little bit softer than we had projected in our January monetary policy report. Now, we have been expecting this adjustment for some time. Last March, my colleague, Deputy Governor Lynn, in our first Economic Progress Report speech, said that housing investment and consumption would, over time, contribute less as exports and business investment contribute more. And this is partly because in mid-2017, we had begun to remove some of the policy accommodation that had been in place for many years. Since then, we've increased our policy rate from 0.5% to 1.75% in October of last year. Now, our policy rate is transmitted to the economy through various channels. It affects returns on savings and investments as well as borrowing rates. It also has a small direct effect on inflation from higher mortgage interest costs. Therefore, it affects decision-making by households and firms, influencing spending and borrowing patterns. So after the global financial crisis, low borrowing rates led households to take on debt, primarily through the housing market. The ratio of household debt to disposable income rose, and vulnerabilities related to the household sector increased. And we've been closely monitoring these developments for some time. Now, our research in this area shows that households would be more sensitive to interest rate movements than in the past cycles, with, of course, the highly indebted being the most affected. And so in 2017, we made some adjustments to our models to account for this increased sensitivity. Now, turning to the housing market, a combination of factors, some that are new and some that were already in place, have been affecting it throughout the course of last year. First, additional mortgage guidelines were introduced in January. They were aimed at improving the future resilience of new household debt. The guidelines introduced a new stress test requirement for low-ratio mortgages, and for some households, this meant a reduction in the amount that they could borrow. Now, borrowers have been adjusting to this through various channels. Some have chosen to purchase a smaller home, or perhaps buy in a different neighborhood. Some have elected to rent rather than buy, or delay that purchase by saving more for the down payment. And others may be just waiting for prices to adjust. But the guidelines are having their intended effect. The quality of new borrowing has improved, with far fewer households taking out a mortgage with a debt to disposable income ratio of over 450%. Secondly, rules have been put in place over the past 3 years by various provincial and municipal governments to curb speculative activity. And lastly, mortgage interest rates have continued to rise. In the middle of 2017, the average 5-year fixed rate was around 2.7%, and by the end of last year, that rate had moved up by around 100 basis points. So these factors caused all facets of housing to moderate. As a result, the housing market remains in a state of adjustment and flux with wide regional differences. It's important to keep in mind that we've seen many global housing markets moderate in countries as Australia or the UK as the level of investor activity has declined. Now, the bulk of the slowdown here in Canada has come from lower resale activity in the Greater Vancouver and Greater Toronto areas. In Calgary, the volume of home sales is off by about 17% from a year ago, likely reflecting the decline in the oil sector. But in contrast, over the same period, we've seen a pickup in sales in cities like Winnipeg, Ottawa, and Montreal. Overall, for 2018, house prices rose by 4%, which is consistent with the pace of national labor income growth. Now, in many major markets, we're also seeing shifts in construction from single-family detached homes to condos and other multifamily units. And this is reflecting demand shifts as well as geographic constraints. For example, in the Greater Toronto area, by the end of 2018, starts for single-family detached homes had fallen by more than half to their lowest level since 1995. This was at the same time that construction of multiples had increased by 25% over the year. And we're seeing this same pattern in other major cities such as Calgary and Montreal, and even here in Hamilton. So in general, complex adjustments, which do take time, are underway in housing markets with significant variability across regions. Now, at the bank, we're tracking these changes very closely, given the importance of the housing market to the overall economy. So now let me turn to consumption. So about a third of our household spending is actually relatively stable. And that's because of what I mentioned earlier. A large portion of that is your rent or the equivalent cost if you own your house. And both of those tend to tick up just a little bit each year. Spending on other necessities, such as your water bill or toothpaste, also contribute to the stability of consumption. You tend to pay that bill and brush your teeth irrespective of your debt levels or what the state of the economy might be. But some spending, of course, is more optional, such as on new cars, travel, or going out. And it's in these categories that we're seeing shifts in spending habits. So let me start with cars. So when Canadians have the money or can borrow it, a new car is often a priority. And from the Great Recession until last year, more people were buying new vehicles every year. And in 2017, that pace of new car buying hit its highest share of consumption in 14 years. So after that and into last year, sales of new cars began to soften. And so that's not a huge surprise, given that people generally don't buy a new car every single year. But at the same time, we recognize that higher interest rates and the slowing economy likely had an impact. In the energy-producing regions, which normally account for about 15% of total car sales, the number was actually off by 6%. Now, some other categories of discretionary spending also slowed, like vacations and going out for dinner. Canadians haven't eliminated them, but we're doing less of both. So while we know that higher interest rates are playing an important role in some of those decisions, there are some other influences as well. And the first is income effects. And to think about this is from the standpoint of as prices of some of the products that we export, such as oil, decline, it reduces our national income from a holistic perspective. And so over the course of last year, we saw oil and commodity prices retreat. And at the same time, we had disposable income growth slow at a lower pace than it had from 2017. And the second influence is wealth effects. When house prices and stock markets go up, people tend to feel good and they spend more. And the reverse is also true, and that's the situation that we had last year. And lastly, there's confidence effects. And so whether you're directly affected by the trade actions that are going on or your neighbor is, uncertainty continues to hang over the economy, weighing on confidence. So in the end, it's some combination of these elements that's weighing on consumption and causing Canadians to be cautious about their spending. Now, most are managing the higher costs of this debt, the carrying costs, by scaling back in some of these areas that I've just talked about, as well as in housing. In addition, Canadians have cut back on their consumer financing. We've seen a slowing in the combined growth of personal loans and credit cards from about 4 to 2% over the course of last year. Now, we're also seeing very low levels of arrears rates and insolvencies across the country. Now, while there may be increases of both in certain sectors or regions, they are rising from a very low base and remain near historically low levels. Now, that's not to say for some individuals struggling to keep up with their payments that it isn't demanding a painful adjustment process. Overall, however, the data suggests that the majority of households are managing their debt levels. So let me now turn to the interest rate decision yesterday and the main points of Governing Council's discussions. And so I'm going to start with a few comments about the global economy. So as we noted in our monetary policy report in January, there's been a slowdown in global economic activity. And this reflects in part some temporary factors, including the U.S. government shutdown and production adjustments that have been made by some of the European car manufacturers. However, some of this slowdown is related to ongoing trade tensions and negotiations, and they may be more persistent. We've seen evidence of this in some of the recent data from China and from some of the other emerging economies. Now, meanwhile, the U.S. economy is moderating as we expected, and we anticipate that it will continue to do so to a pace that's closer to its potential. Now, some major central banks have changed their communications in recognition of softer global economic momentum. And their shift in tone has contributed to an easing in global financial conditions. Many equity markets have rebounded from earlier lows, and credit spreads have narrowed. Now, of course, the main source of uncertainty in the global economy continues to be the future of trade policy. Notably, the current talks between the U.S. and China. And while there's been some promising signs in those negotiations, trade uncertainty on a global basis remains a two-sided risk. An escalation or expansion of trade actions could have serious consequences for the global and Canadian economies. And on the other hand, successful resolution of trade tensions would remove a significant source of uncertainty and provide a major lift. Now, here at home, Canadian data are reflecting this slower economic global momentum. In that regard, Governing Council spent a lot of time discussing the national accounts data for the fourth quarter of last year that we received last Friday. In our January monetary policy report, we said that we were expecting weakness in the fourth quarter of 2018 and the first quarter of this year. And this was due to the decline in oil prices late last year, coupled with some production curtailments, which had an impact on the energy sector. And we projected that growth would pick up starting in the second quarter. Well, as it turned out, the slowdown in the fourth quarter was sharper and more broadly based than we expected. And this came despite strong growth in employment and in labor income. Now, while the anticipated slowdown from the energy sector was actually fairly aligned with our projections, other categories surprised. So given the data presented a mixed picture, I'm going to spend a little bit more time on the national accounts numbers that we received last week. And so I'll walk through the main economic categories, starting with business investment. So for 2018 as a whole, investment grew by 2%, which was less than we had been expecting. And this reflected weakness both in the third and fourth quarters. So what might explain this? Well, while many companies were relieved to see the successful negotiations to replace NAFTA with the Canada-US-Mexico agreement, they continued to wait for the deal to be ratified. That may be the case for some of you in this audience. And so it's possible that some companies are delaying investments amid that uncertainty. And of course, that uncertainty isn't limited to just the new NAFTA. Global concerns, particularly on the US-China trade front, are clearly hurting confidence and leading firms to delay investment decisions. Now, another possible explanation for the weakness in investment is timing. The accelerated depreciation tax changes that were announced late last year by the federal government are welcome news for corporations, and it's possible that in anticipation of these changes, investment decisions were postponed. If so, we should see a pickup in business investment in the first quarter, which would be consistent with the recent readings that we've had in our quarterly business outlook survey. Now, we will have an updated survey by mid-April, which will help to further inform our April interest rate decision. So next up is exports, where the profile was also weaker than we had expected. Now, one bright spot in exports was services, which grew by more than 6%, led by commercial and travel services. Now, I've already talked a fair bit about housing, and the biggest negative surprise in this category for the fourth quarter came from renovations. So as I noted before, there are significant adjustments occurring in housing markets, and it will take time for these adjustments to be completed. Nevertheless, the national rate of mortgage credit growth increased slightly in the fourth quarter, and so we'll have to wait and see what happens with sales once and if spring rolls around. And so I'll end my speech on the I'll end on the topic of my speech today, which is consumer spending. It, too, was lower than expected in the fourth quarter, with categories more sensitive to interest rates continuing to soften. And we're aware that many of these purchases in the consumption category would be linked to the purchase of a new home, so that's likely one of the reasons. But to better determine the factors at play, we will need more data. So to sum up, while we figured that the economy was in for a detour at the end of last year, that detour may end up being longer than we had expected. It now appears that the economy will be weaker in the first half of 2019 than we had projected in January. However, we still expect Canadian economic growth to pick up later in the year. And this will be supported by ongoing strength in employment and rising wages. We will have more to say in April when we will have our new economic projection as well as our annual updated estimates for potential output and the neutral rate of interest. So let me close with the key policy message from yesterday's press release, and I'm going to start with it in French and then repeat it in English. Le Conseil de direction estime que les perspectives continuent de justifier un taux d'intérêt directeur qui se situe sous la fourchette neutre. Compte tenu du bilan contrasté que l'on peut tirer des données, il faudra du temps pour juger la durée pendant laquelle la croissance restera sous son niveau potentiel, ainsi que les implications pour les perspectives d'inflation. Étant donné l'incertitude accrue quant au moment des futures hausses de taux, le Conseil de direction surveillera attentivement l'évolution des dépenses des ménages, des marchés pétroliers et des politiques commerciales mondiales. At yesterday's decision, Governing Council judged that the outlook continues to warrant a policy interest rate that is below its neutral range. Given the mixed picture that the data present, it will take time to gauge the persistence of below potential growth, and the implications for the inflation outlook. With increased uncertainty about the timing of future rate increases, Governing Council will be watching closely developments in household spending, oil markets, and global trade policy. Thank you for your attention. Okay.
Well, thank you so much for that.
You're welcome.
And again, thank you for, we're going to get this moved over here for you folks over there. Thank you again for choosing Hamilton.
You're welcome.
You said that this was your choice. You wanted to get out of Toronto, and I thank you for providing leadership on that. So again, folks, we're inviting questions from the floor via Slido. The instructions are on your table. This is the first event that we're doing this as part of our ongoing efforts to be a more digital organization. So I'm sorry about that. I hope that we don't have any complications. But I do have a couple of questions prepared in advance anyway. So first of all, you talked a little bit about tariffs. And obviously that's the biggest issue for us as a community. We don't have to go into the fact that obviously we're a historical manufacturing town. But we do know that the steel industry employs about 10,000 people here in Hamilton, has a spin-off effect of supporting another 40,000 jobs as well. So talk a little bit about the weightedness that tariffs have on your overall decision. And I guess maybe to flip it, if, as Ambassador McNaughton predicted, tariffs were eliminated pretty soon, how would that affect everything that you just said today?
Right. Okay, well, that's a good question. I mean, and without question, we know that the trade uncertainty, as I mentioned, and the trade tariff activity is causing the economy to not perform as well as it could if they weren't in place. And tariffs obviously allow the economy to underperform. They also can cause inflation because it can impact the prices of your imports. And so, it's, I'm sure, been very painful for many here in the community, especially, when you try to figure out the persistence, I guess, of the tariffs. Because I think, in particular with the steel and aluminum, there was an expectation that they might be on for a period of time that wasn't going to be particularly long. And, I think shortly after they were put in place, some of the conversations that we had, because we do a lot of outreach to communities, both through the Business Outlets survey, but generally as well, was people were trying to find short-term solutions, right? Workarounds, work with our client base, work with our suppliers, try to figure out how to get through this. But clearly, if tariffs become more persistent, then we're looking at maybe more structural adjustments that have to happen. And, I guess one of the things that it kind of highlights to us at the central bank is that the more diversification that you can have with respect to your customer base and with new trade agreements like CETA in place and CPTPP, obviously if you think tariffs won't be long-lasting, you won't necessarily make the same investments, but clearly to have other markets that you can expand to is a good thing. So to the second part of your question, I mean, I mentioned it in the speech, there has been a pall that's impacted sentiment significantly. I think it's a very difficult environment to make business investment decisions when you're not too sure about what the trade environment's going to look like. So I think we could have a material lift with respect to sentiment, which would then, I think, fall into investment decisions and hiring decisions that could be quite a material lift, not just to Canada, but on a global basis. So I think that's what we would certainly be wishing for.
Well, we're certainly hoping for that as well, and I hope that Ambassador McNaughton had some inside information when he said that last week. I think that to expect the tariffs lifted soon. Let's shift gears just a little bit, well, a huge amount actually, because tomorrow is International Women's Day, so I want to ask you about that. The theme for International Women's Day is balance for better. And of course, balance is not just a women's issue. We talked a little bit about this before the lunch. It is a business issue, and gender balance is essential for economies and communities to thrive. I think we've seen enough research that underscores that. And we as an organization are also working on an accelerating women in business network so that we can help women of all socioeconomic backgrounds here in Hamilton, provide them with the tools, skills, and confidence they need to excel in business and the workforce. So more information to come on that. But can you speak to the economic impact that occurs as a result of increasing diversity in leadership, as well as women's overall participation in the workforce?
Sure, I'd love to. Happy International Women's Day, everybody. Yeah, I mean, you know, it's actually really timely and kind of related, even though it was a bit of a left turn, because, you know, in April, I mentioned in the speech, we update what potential is for the Canadian economy, and though one of the inputs is trend labor input, and you know, we have an aging demographic. We're relying more and more on immigration to keep that trend labor input from going on a downward trajectory, and so being able to bring more women into the workforce can actually really help to alleviate some of that tension and that downward trend. The governor gave a speech last year in March where he talked about just getting labor force participation by women in, I think, the prime rate ages, which I'm not in anymore, I don't think. But anyway, 24 to 55 or something. But getting participation rate up with that cohort, you know, could mean as many as 300,000 more people in the workforce, females in the workforce. And so I think it's a really interesting time, particularly with all the technological change that we're seeing today. And so, you know, I would say that flexible working type arrangements, that, you know, corporations probably need to be a little bit more innovative in how they might address trying to get more flexible employment, potentially, you know, for women, but not just for women, for people with disabilities. I think there's an opportunity with the rate of change that we're seeing in the way people work today to address some of these issues. So yeah, I think there's a lot of enhanced potential, no pun intended, for us. And certainly, you know, if I turn it to the bank for a moment, you know, diversity and inclusion is a big focus for us. We certainly benefit from diversity around all of our tables, and not just diversity of gender, but diversity of thought and experience. And I think it's enriched some of the conversations we've had by promoting that as much as we can.
Great. Thanks for being willing to answer that question. Okay, so we have a couple coming in from the floor. To what degree does the skills gap factor into the lack of wage growth we've seen across Canada in spite of low unemployment rates? I know that most of our members, many of them are not in the steel industry, so they're not as impacted, but most of our members are impacted by the skills gap and are having trouble finding talent.
Mm-hmm. Yeah, we hear this in many places across the country. And it's a tough one because we have, you know, I think there's close to 500,000 unfilled job vacancies right now. And clearly there's some skills gap with those that are still looking for work. And so, you know, I think we're going to need more training programs. I mean, we're seeing, I think, the pace of change in global economies speed up. It feels like it. And so, you know, we're going to need more done with respect to skills development and training to try to address that. And at the same time, as you say, you know, we're not seeing the wage growth, even though we've got some of these tensions. And obviously, part of that is because there's a gap between who's looking for a job and the skills they have and what's required. You know, in some places, we're seeing a bit more wage pressure than others. Senior Deputy Governor Wilkins did a speech earlier this year specifically on wage growth and where some of those issues might be coming. We had an interesting chart in the January Monetary Policy Report where we tried to look at what wage growth was like in the energy-producing provinces versus non-energy. And so that gave us a little bit of insight that if you stripped out the energy-producing provinces, where we know there's been less wage pressure, that we're running a little bit closer to the 3% level. So, but I think it's an ongoing issue that I'm not quite sure how we'll solve it. But
okay, well, we'll keep trying for sure. Since the average mortgage term is 4 years, and we have seen 5 rate hikes since 2017, how much is the maturity lag considered when raising or decreasing rates?
Yeah. It is considered. We actually have some great models where we can look at that. In fact, I'm not going to get the timing right, but in one of our monetary policy reports, maybe a year-ish ago, we had a special box where we actually looked at the 2014 cohort of mortgage holders, 5-year fixed, and the 2015, and looked at what would have happened to, if they had average income gains and then mortgage rates moved by either 100 or 200 basis points, and how well they would be able to manage that. And, that analysis showed that they were going to see their debt-to-income ratios having fallen off through that period, then come back up, but still to a manageable level. So we at the bank have some microdata now where we can actually monitor this very, very closely. And so the staff are working on those types of things more and more. I mean, it's true that's what the 4-year fixed is. I don't have the last numbers at the top of my head, but as you know, we have a fair amount of our mortgage product where people have selected variable rates, and then you've got some in 3 and 4 and 5 year. And I think recently we've seen some interesting movement in longer-term mortgage rates that actually make them look a little bit more competitive. So whether or not we'll see some of the mortgage products move out in the post-5-year era. But these are all, very important things for us to watch, and we do. And it's part of what's built into our models to assess how that debt burden is shifting over time as interest rates move.
Okay. We have another mortgage question. Are you concerned that increased regulation of conventional mortgage qualification rules may be forcing Canadians to entertain unregulated lending options?
Well, let me say that the regulations that have been put in place recently have had the objective to try to improve the quality of new mortgage debt, and that has in fact been happening, and I mentioned that in my speech. So if you cannot access the conventional mortgage providers because you're not meeting that stress test, then you're going to look for other forms of funding, and I mean, I think that's part of the adjustment process that we're going through, and so I think that we have to monitor that. We want to be concerned if that part of the market becomes too large, because then we want to see if there should be more regulation around it. But obviously that also comes at probably a higher price. And so, you're going to have some trade-off there in how much you might actually see rotate to those types of lenders.
Right. Okay. Related to that, there have been comparisons of Canadians' personal debt level as worse than what the American levels were at prior to the 2008-2009 financial crisis. Do you have any thoughts on that?
Well, I think it's a bit comparing apples to oranges. So I would just say that, yes, we've been talking about, vulnerability to the financial system being the levels of household debt for a number of years now. And if any of you read our financial system review, we focus, it's always our number one vulnerability. And so we're very aware of it, but we also look at the characteristics around that debt, and it's very different from the situation that the U.S. was in 08 and 09. So we're focused on it in Canada. We're looking at the composition of it and how it what the component pieces are between mortgage debt and other consumer debt. But we think that it has a very different set of characteristics, including better income verification, and the whole process that surrounds the mortgage process in Canada is very different than what was happening in the 08-09 era in the U.S.
Okay. All Time for a couple of questions left. I want to first acknowledge Sandy Shaw, our local MPP from Hamilton West, Ancaster, Dundas. It's a tough one. She's the Finance and Treasury Board critic. And I mentioned the fact that the businesses that did the survey that we did in conjunction with the Ontario Chamber of Commerce, there's a little bit of a confidence gap in the provincial economy versus their own economic outlook. And I'm just wondering, in terms of how you make your decisions, and do you look at a provincial, province by province by province, numbers and trying to gain an overall picture of the national economy?
Yeah, well, we would, we look at the economy from a macro perspective, so we would see those building blocks after they happen, but we wouldn't forecast each province separately. And yeah, that would not be part of our process. But yeah, that was an interesting chart that you showed, and I think I kind of spoke to it a little bit in the speech, that we do have some disconnects between what businesses or individuals might be telling us, and then when you put the collective whole together, just with respect to confidence right now. And I think we do think that negative sentiment is weighing on activity, and clearly over the coming quarters we want to see more data to see if that persistence is there or if it is in fact something that's a little bit more temporary.
Okay. Well, that is all the questions that I have, and it's a good thing we got 1 minute left, and so this is perfect. Again, I want to thank you so much, and for closing remarks I'd like to invite Scott Galbraith up, the District Vice President for TD. Scott?